We were talking about this the other day. I think Jeremy said we think this may be the 10th year that we've been out here in Dodge City, and it's always such a delight. It's such a wonderful community. I really, really appreciate the sense of community and the way that you all have a common vision for what you want for your community, and I think that's really neat. At your tables, you should see copies of our annual Ford County Housing Outlook publication. I don't know if we have any of you here from Finney County or from some of the other counties in the region. We actually prepare those for 23 different counties across the state. We only printed the Ford County one here for you today because that was, we wanted you to have something that was directly related to Dodge City. But if you're interested in the outlook and the information about those other counties, you can find all of that on our website at realestate.wichita.edu. You'll see a little link there for the housing forecast that looks a lot like the cover of that. And so you'll see all of our publications and everything that we had. We need to give a big thanks to Security First Title because they are the ones that made it possible for us to print this publication for you, and they've been big friends for the Center for Real Estate for a long time and supporters in the community, and so we're very, very grateful for that. We're also grateful for the partnership that we have with the Kansas Association of Realtors and all of the local realtor boards around the state, including the Dodge City Board of Realtors. And it's through that partnership that we actually have access to the local MLS data. We help prepare those monthly MLS statistical reports that Nicholas was talking about earlier, and that gives access to those data. So, every year this time, we release our annual Kansas Housing Markets Forecast, and we look at a number of things in terms of trying to say what's been happening in housing markets in Kansas and what do we think will happen going forward. This year was one of the most challenging years that we've had, certainly since at least, say, 2009, 2010, in terms of projecting what would happen going forward because we've seen such incredible volatility. Concerns about a potential recession and what's happening in labor markets. Jeremy talked about those. The other side of things is in financial markets, and as most of you know, mortgage rates have gone up almost 4% compared to where they were just at the beginning of this year. This level, more than doubled. This level of increase is something that I've never seen in my lifetime, and I went through, when I bought my first house, a really sharp increase in mortgage rates between the time that I got my job offer in Cleveland and I could actually get a contract on a house. Mortgage rates went up about 2.5%, and I thought that was extreme. What we've seen here right now is even more extreme over this year. I will note that when we went to press with all of our forecasts, and I had to have everything in, that was in early September. And so the interest rates that you will see in your publication at your table look somewhat different. At the time that we finished all that up, mortgage rates had topped out at about 6%, 6.5%, and then had come back down to close to 6%. And at that point in time, it looked like financial markets were saying the Fed is going to keep inflation under control and that we think we may end up with a soft landing. And so mortgage rates were beginning to come back down. After all of that happened, we then saw these really, really strong labor market figures that kept coming out with strong job growth and other things, and also continued increase in inflation figures. And in response to that, mortgage rates have now gone up and they are just under 7% right now. I think it's just like 7.94% or something was the number that came out yesterday. That being said, I check every single day. The orange line that you see on here is the Mortgage Bankers Association's forecast for the 30-year fixed mortgage rate. And they still have, well, they've changed it from what was in your publication. In the publication, they were forecasting the rate next year would be 4.8% by the end of the year. Right now, their forecast is a lot higher, 5%. And I joke a little bit with that because we are still waiting for them to come out with their next revision. Often they come out with a revision every single month. I am sure that number will come higher. But I do believe their forecast is still going to be for mortgage rates to fall over the coming year. And my reason for that is primarily related to what we expect will happen with inflation. If inflation were to stay very high, mortgage rates would have to go up substantially in order to justify that. Right now, at an 8.2% inflation rate and a 7% mortgage rate, if we stayed at that point, Joe, would you go out of business pretty quick lending at 7% with an 8.2% inflation? It's just not sustainable to lend money at an interest rate where the dollars you get paid back are buying less than what you actually invested in the first place. I did not include a slide in my presentation here today. If you go to our website, you'll see some other presentations I did, including one that I did in Wichita on Wednesday, where I talk about a number that we call the break-even rate. And some of you may have heard of this number before. It is a measure that economists and financial markets use as a projection of expected inflation. And that break-even rate is calculated by looking at Treasury security rates. So if we have a 5-year Treasury security and you buy a Treasury note, it would have a face value or a loan amount of $1,000, say. And then you receive semi-annual interest payments from the federal government. Every 6 months, they send you interest on that $1,000 face value with whatever the interest rate is. And then at the end of 5 years, they pay back the entire principal balance. All of those payments are nominal payments, meaning they're not adjusted for inflation. And so the interest rate on the regular Treasury security has to include an inflation premium, recognizing that the dollars that the investor gets back in the future are going to be worth less than the dollars that they gave today. Okay? So we build an inflation premium into that interest rate. But there's another type of Treasury security called a TIPS security, TIPS, for Treasury Inflation Protected Security. And that security is very similar to the traditional Treasury with one big exception. At the end of each year, they go back and they say, how much inflation did we have over the past year? And they increase the loan amount on that note based on actual inflation that's occurred. So if you have that $1,000 Treasury security and we've had 8% inflation, then they would increase the face value of the bond from $1,000 to $1,080. And that would be used to calculate your interest the next year. And they do that again the following year. And so it might go up to $1,120. And every year, the face value of the bond would increase based on actual inflation, and that would then be the amount that you get paid back when it matures. Because this security you get protected on the back end from actual inflation, the interest rate that you have to pay on it up front can be lower because it doesn't have to build in that inflation premium. Now, sorry, that's a lot to explain. But the difference between a regular Treasury security and this TIPS security is a direct measure of what investors who are putting literally billions and billions of dollars into these financial markets, it is a measure of what they expect inflation to be on average over the next 5 years. You can think of it like the Kansas City Chiefs football line, right? It's that line, I think it's at 3.5 points right now. The Vegas odds makers are simply changing the odds based off the line based on trying to make sure there's the same amount of money betting the Chiefs will win versus betting the Chiefs will lose, okay? And so that line is reflecting the collective wisdom of everybody who's investing. It's really a market price for that game. The same thing is true with this break-even rate. Investors will buy or sell these securities based on what they think inflation will be. So what's the takeaway? Right now, the 5-year break-even rate for these Treasury securities is 2.5%. That means that investors who are, again, putting literally tens and hundreds of billions of dollars into these markets are betting that on average, over the next 5 years, the inflation rate in the US will only be 2.5%. That is where I hang my hat to say inflation is likely to come down. Now, could the investors be wrong? Absolutely. The Chiefs could also win by 50 points this weekend, right? So just because you have an expectation doesn't mean it's a guarantee, but be careful about betting against that expectation over the long period of time. You're probably going to lose. You're not going to outguess the collective wisdom of the market. So, mortgage rates we think are going to come down over the coming year. What's been happening in home sales activity over Dodge City? Dodge City has actually been a little bit different than a lot of the markets across the state here over the last few years. Now, I'm very curious about what you said, Nicholas, about the home sales not showing up here in the MLS. The MLS rules are supposed to state that if a realtor is involved in a transaction, even if it was never on the market originally, they're supposed to go back and put that in the system. Now, whether or not that actually happens depends on how the system, self-regulates and monitors. Do you have something you wanted to throw in on that?
Realtor sold is what they are.
Right.
They never deal with any sort of realtor whatsoever.
And what often happens with new home construction, and this is true all over the state, if you look at building permit activities and you look at what's designated as a new home sale, it looks like we're terribly overbuilding compared to the number of new home sales that we have. But that's because builders will often put 1 or 2 homes on the market as a spec home or a sample, a model home, and they'll put that in the MLS system. But then when somebody comes and they buy a custom home or they do something else, those homes never get put into the MLS. So new homes are definitely underrepresented, and that's true not just in Dodge City, but everywhere. These home sales activity do include both new and existing homes, but existing homes are what dominate the numbers on these things. And to the extent that you have new homes that are sold, this could easily underrepresent that. But one of the things I wanted to do with our forecast this year was to give a more historic perspective of what's been happening over time. And so I went all the way back to 2010, and you can see that while most of the state saw some pretty steady gains in home sales activity starting at about 2011, Dodge City just kind of plugged along at its same normal level until we hit about 2017. There were some ups and some downs, but pretty strong in 2019. And then 2020, when the rest of the state, the rest of the country for that matter, just absolutely took off in late 2020. Dodge City was really slow to start that party. It didn't start until midway through 2021 that home sales activity have really accelerated. And where home sales activity have slowed in most parts of the state over the last 6 months, Dodge City sales continues to accelerate, much stronger home sales activity. Now, one of the issues that we've been dealing with in terms of the housing market has not been a demand side issue. It's not people wanting to buy homes. That's been pretty strong across most of the state. The challenge that we've seen has been a lack of inventory. And so this is the number of homes that are listed on the market. And again, this won't show some of those new home construction that you have here. But the thing that we've seen that's been really remarkable here, and this is true across the state, has been the incredible reduction of inventories from where you were sitting at around 125 homes on the market available at the end of 2019 to just over 50 homes that are available for sale right now. And while that's come up here recently, it's still far, far below where it had been historically for a number of years. There's a lack of inventory that's available for people who want to come in and look at the market.
When you look at those available for sale, do those include the ones that are under contract?
Available for sale does not include under contract. Once it's put under contract, it is moved its classification from what's called an active listing to a pending listing. And in the monthly MLS statistics, we actually do have numbers that show the number that were put under contract in a given month and also a separate number for those that are pending sale. They're waiting to close. That might have gone under contract a month ago. It might close a month from now, but it's still pending, waiting. And so those statistics are available. So we have this demand side of the market, and we also have the supply side of the market. One of the ways we try and measure balance in the housing market is through a number that we call months supply. And what we do is we take the number of homes that are actively available for sale, and we divide it by the average pace of sales over the prior year. So if you had 100 homes that were available on the market right now, and on average you were selling 20 homes a month, then we would take that 100 divided by 20, and we'd say you have a 5-month supply. Traditionally, as economists, we like to think about a balanced market as being one that has between a 4 and a 6-month supply. That's why I have that shaded area in that graph. More than a 6-month supply we think is more consistent with a buyer's market. The market, the negotiating power favors buyers. Less than a 6-month supply is, less than a 4-month supply favors sellers. It would be a seller's market. And just because we state that as kind of our benchmarks doesn't mean that buyers and sellers act that way. There's a lot that tends to be very local market conditions and local conventions about where a balanced market is. But what you can see here, again, going back to 2010, and if you look at the US number, which is the teal line there, month supply went up to almost a 12-month supply nationwide back in 2010. That was the depths after the financial crisis. And then we began whittling away those numbers, and we got back to a balanced market nationwide by about 2012. The purplish line there at the bottom is Kansas, and you'll notice that Kansas as a whole entered into what we would call a seller's market back in 2015, and it steadily continued down with really, really tight inventories that just accelerated in the wake of the pandemic. Dodge City has bounced around a lot more. There's a lot more volatility that you have because you're starting with a lower base of active listings and a lower base of sales. But you never really got extremely tight in those years from 2015 to 2019, the way many markets across the state did. Then once we got into early 2020 and into the pandemic, sales activity began to accelerate, and this month's supply just absolutely evaporated. And so now you're in a place where you're roughly a 3-month supply right now, which is very, very, very tight for Dodge City. So one of the things, there are a couple other ways that we measure and think about what's happening in housing markets. One is, how actively are buyers negotiating discounts? So this is a measure of the percentage of homes that sold that are selling at a price that's lower than the original asking price. And back in 2010, 2011, statewide, that was about 80% of homes sold at a discount. That was that time when we had a seller's market statewide. And then that came down and it dropped down into 70 and even down to about 60%. When it was at that 70% level, that was very consistent with a balanced market statewide. What does that mean, 70% selling at a discount? Well, if 70% sold below the list price, it meant that 30% of homes were selling at a price that was higher or above the original asking price. And then again, you can see, starting in 2020, we just saw this absolute plummet in the number of homes that were selling at a discount, where now, both in Ford County and in Kansas, it's less than 40% of homes are selling at a discount compared to list, or 60% of homes are selling at prices that are at or above the original asking price. That, to me, is a real indicator that it's still a seller's market, given that that sort of competition is happening and the bidding is raising prices rather than bringing it down.
Are you seeing that being focused in those certain price ranges of homes, like the higher end homes are seeing more of the at or below, and the ones that are the lower tend to be higher. And
so the question is do we see that across all price ranges, or are there particular segments? I tend to look at things from a 30,000-foot view, and so I don't tend to get in the weeds. That's something that I like to ask people local in the market and talk with realtors. I will tell you what I've heard from realtors across the state right now, both from our roundtables back in August, but also from other presentations that I've done. And this has been consistent whether it's been down in Pittsburgh or in Hayes or in Lawrence or in Wichita. In the most desirable segments of the market, those mid-priced homes that are in the most desirable neighborhoods, they are still seeing bidding wars for those homes. As you get into homes that maybe are not as prepared for the market, needs some TLC, or it's in a price segment that's upper end of the market, that's a little thinner, not as many potential buyers, those homes that are not in that sweet spot, those have been softening in recent months. That's the story that I've heard. And I'll be interested to hear from all of you what you sense from the Dodge City market. The story then with all of this, when you have pretty strong demand and you have really tight inventories, that means rapidly escalating home prices. Now, the median sale price is just the price at which half the homes sell at a higher price, half the homes sell at a lower price, and that can be influenced by composition. If we sell more upper-end homes, that's going to be driving up median sale prices, even if underlying home values aren't going up. But I will say from a statewide perspective, controlling for that composition effect, average home values across the state have gone up almost 17% through the first half of this year compared to the prior year. And you can see median sale prices going up from below $100,000 back in 2010 to where now you're up at nearly $160,000, $165,000. That's a really, really, really strong appreciation. And I think that's representing both composition effects of building new homes, higher, more expensive homes on the market, but also underlying home price appreciation. What's been driving that? Go ahead, Joe. So that's the question that we've had. Has this home price appreciation, and again, I'll show you here just on my my numbers that I have here, you have last year, through the end of last year, Kansas home prices appreciated by 14.6%. That pace of appreciation accelerated through the beginning of this year. We think that's slowing right now, but we still think by the end of this year, Kansas home prices on average will be up 12.3% compared to having already appreciated by 14.6% the prior year. And next year, we think it's going to slow to 5.4%. That's still really strong, more normal appreciation for Kansas. And so that question that Joe asked, are we in for a bubble? Could we see home prices collapse? And my answer to that is I would be absolutely stunned if that were to happen. And the reason is the shortage of inventory. Here's what I see happening over the last several years. When we entered the pandemic, we thought that home demand for homes would fall off a bit because of we anticipated a recession in the wake of the pandemic, and we thought that that would cause buyers to pull back. But we thought that the bigger constraint was a lack of homes available for sale. Statewide, we were sitting at just over 2 months' supply prior to the beginning of the pandemic. And so we actually said that pullback in demand could actually help the market catch up with the lack of inventory that we'd been building for about 10 years. Well, instead, 5 things happened during the pandemic that I think just absolutely hit a blowtorch to this kindling of lack of supply. Number 1, we didn't see the demand drop off among potential home buyers because it turned out that the home buying population was the least likely to lose their jobs during the pandemic. The people most likely to lose their jobs were people who worked in places where you had to physically be present in order to do your work, and you weren't deemed an essential activity. And so therefore, those potential workers, they tend to be more likely to rent, not to buy. So home buyers didn't really suffer the way we thought they might. But home buyers did receive the stimulus checks just the way everybody did from the federal government. But because of the shutdowns, they couldn't go spend the money going out to restaurants or travel, and even some of the things they might have wanted to buy. Supply chain issues made it hard to buy. And so as a result, household financial situations got into their best places that they'd been in decades. Then number 4, because of the shutdowns, people tended to be sitting around staring at their own 4 walls more than they had been in the past. And so we started to get cabin fever and just want something different. I don't think there was a lot of people moving to Dodge City because they wanted to get out of the big cities like Denver or Dallas. They didn't do it to Wichita either. But people who did live in different communities started saying, I want more, I want something different. And then number 5, the Fed really juiced things up by pushing mortgage rates down to the lowest level they've ever been. And so those 5 factors came together to really ignite demand in a situation where we were already short of inventory. That's what caused these historically unprecedented home price appreciation. And that home price appreciation will slow down. It's not sustainable, it's not realistic for Kansas. But we don't see a situation where home prices will plummet. Worst case scenario, Jeremy talked about it, kind of his best case and his worst case scenarios. Worst case scenario is that home prices flatline for a while. But even that I think is unlikely because supply issues are so tight. But that actually brings us to a good place to go ahead and bring our panelists up. And so let's go ahead and come up. We actually have had a number of things happen here today that were unexpected. Yes?
I have a quick question.
Sure, go ahead.
In regards to home prices appreciating substantially, some communities, from a tax perspective, are staying a lot better with that inflation.
Right?
Some communities are trying to temper that down a little bit.
Right.
They think it's going to flatten and maybe even decrease a little bit based on whatever their models or other systems they have in place. So is it a matter of time they'll just try to catch up, you believe, the tax appraisals and from a county level, or what do you think is going to happen there?
I have not seen what's been happening with Ford County tax appraisals and so forth. I have seen what's been happening in Sedgwick County, and it always lags underlying real appreciation.
Right.
You know, they have the county assessor's offices are required under state law to match market values, and they do ratio analysis to try and make sure that they're keeping pace. It's been impossible for them to keep pace in this particular market. But nonetheless, tax assessments, you know, the assessed values for properties across much of the state have gone up pretty dramatically. Many communities that I've seen have said, we're going to take advantage of this to lower our mill levy. We can simultaneously lower the mill levy and still have increasing revenue streams from that because of this high appreciation. I don't think that that's necessarily a danger zone for that in terms of, then if home values decline and they've got to raise mill levies. Again, I'd be very surprised if we saw that happen. So, but it is, you have to think over the long term with those things because it's a lot easier to lower a mill levy than it is to raise it. So, okay, well, we had 2 of our panelists who, because of personal situations, were very, very sorry, but they could not join us. Brian Delzite and Michelle Salinas both had unexpected circumstances that happened, and they apologized profusely. Joe DeMuth is here with us, and then we have our substitute here with Mollea Wainscott. Oops, I had it here, so I did pull up your bio here, Molly. So let me introduce our panelists here. And so, if I can get that, I want to get it in the right place so that it's there and catches me but doesn't overwhelm things. Mollea Wainscott joined the Dodge City Ford County Development Corporation in September of 2015 as the Special Projects Coordinator for Housing. In June of 2020, she was promoted to Assistant Director of Economic Development. She oversees projects for the Community Housing Association of Dodge City, including the Abandoned Housing Program, Community Home Renovation Program, and Paint Dodge City. Molly also focuses on community development for Buckland, Ford, and for Spearville. So please join me in thanking Molly, especially because she joined us here on the fly without having any prior preparation. So thank you, Molly. And then we also have with us Joe DeMuth. Joe is Vice President of Mortgage Banking with Landmark National Bank in Dodge City. He graduated from St. Mary of the Plains College with a degree in Business and Accounting and has been originating mortgage loans for Landmark National Bank for the past 30 plus years. So thank you once again for joining us, Joe. So one of the things that I noted here that is, again, Dodge City is different from almost every other market that I've looked at here across the state in that home sales activity have been accelerating this year, whereas in most parts of the state they've been declining, in part at least because of those rising mortgage rates that we've seen. To what do you attribute the market strength in Dodge City for the home sales activity increasing?
Well, I think a lot of that comes back to what Nick said, and the plants, our two biggest major employers, increase wages.
So increased wages, making it easier for people to be able to afford and buy. Joe?
I would definitely agree with that, and just a matter of supply and demand. I think supply has been so low in the last 2 years that the demand is there. And with that extra bonus income, extra hourly wage, it's disposable income they want to spend.
Well, I want, again, unfortunately, our two realtor members here who can kind of tell us what they've been seeing from their buyers weren't able to join us here today. But I want to throw it out to all of you. What do you see? Why do you think that home sales activity has increased here in Dodge City, even as mortgage rates have gone on a historic increase?
Stan, I think we've also seen a lot of the lower end homes, people who own those, buy up. Mm-hmm. And then we've seen investors buy some of those lower end homes and turn them into rentals as well.
And so that actually is an interesting piece because you say the lower end homes, people have been able to move up. And that's been a real challenge in most of the state is that, I mean, when I talk with realtors, they say, we've got people who would sell. They would put their homes on the market, but they're afraid to become homeless in the sense that they will sell their home too quickly and then they won't be able to find the home to buy. And one of the things, Nicholas, that you were talking about earlier was the remarkable increase in some of the new home construction projects that you've had that maybe has allowed that side of the market to free up and to be able to go through. Do you want to talk about some of those projects, Molly?
I think that they'll sell their house knowing that there's such a housing shortage that the house that they sold will be bought quickly, that they weren't worried about that. So they'd buy and then sell.
Okay. Anybody else have comments about that new home construction?
I think one of the things that Molly touched on though too, with the houses being bought by prospects, for investment properties to turn around and rent, that's going to cause a huge gap in the amount of potential buy-up home buyers. We don't have that entry-level home, as many of them as what we need. And I think that's where a lot of our need is going to be in the next several years, because we have plenty of builders building that next level of investment. We have very few that are building those entry level, like I was talking about, stick build boxes, those 1,000 square foot boxes that just get you in as a homeowner to begin with. Mm-hmm. And I think we're going to have a challenge there.
We have a lot of multi-generational families as well, where the parents live with the kids, you have grandparents that still live at home, and with the rise in wages and stuff, these people have been able to build up their savings to be able to do their down payments. So parents are staying in their original home, where the kids that are now married and have their own kids are purchasing their own homes. So that's also hurting that resale, because there wasn't anything for them to sell. They just moved into a new home.
Right, and that actually brings up, so this multi-generational housing where now people are expanding, maybe the kids were living with the parents and now the kids have had their own kids and they want to go out and buy their own. That's been something that we've talked about also, is the increase in, or the decrease in the number of average people per household. And that's a trend that's a nationwide trend, but can be especially acute when you have some of the situations of that multi-generational household that you have here in this community. So Molly, you were talking last night, and tell me more about community. When I go around the state, especially smaller communities like Dodge City, for years and years and years have talked about the challenges associated with building new homes, and with that gap between what it costs to build a new home and what the people in the community can actually afford to buy. And it sounds like Dodge City and Ford County have been especially effective in really getting ahead of the curve on that and doing something. So tell us what's been going on.
Yeah, they have. So we started, I think, back in 2009, and it's really all the taxing entities came together and utilized the state incentives, the biggest one being the Rural Housing Incentive District, that will allow the developer to capture the incremental increase in property taxes to pay off the infrastructure. And so the city will also let the developer petition for specials in order to cover that infrastructure cost up front. It's really hard for a developer to come in and put in $1 million, $1.5 million worth of infrastructure and then still have money to build homes after that. And so we started that back in 2009. One of the leaders in the state, Dodge City, is on that. And we're very fortunate. We have a couple developers who've done it and done it really well and continue to do it.
Very good. Well, Jill, let me ask you about how you often see the buyers before they are actually going out and talking to a realtor. If they're doing it right, they're talking to you to find out what they can afford and how that will work before they take anybody's time or their own time in searching for a house. How are buyers responding to this increase in mortgage rates, and couple that with the increase in home prices that we've seen that really makes affordability even more of a challenge than it had been before?
Sure. Well, I think a lot of them are sticker shock when they come in, especially those that came in 6 months ago and got pre-qualified at 4%, and now they're coming back and finding rates are at 7%. But a big part of what we do when we're qualifying them is we look at ratios. We look at their monthly income, and we typically don't allocate more than 29% of their monthly income for their housing payment. There are some exceptions to that. So if a guy's making $5,000 per month, roughly 30% or roughly $1,500 per month is what he qualifies for. Our average loan here in Dodge City is about $150,000, and for each 1% increase in rate, that increases their monthly payment by approximately $100. So a 4% increase in interest rate has increased that monthly payment by $400. So it definitely has an impact. I probably see it more on single family wage earning homes than a multifamily wage earning home. Usually if both of them are working, especially at the plant, but they're each making the $5,000, then they qualify a little easier. But if there's only one wage earner in the home, it definitely will affect the purchase price. I think I've seen something on MSNBC that says for each 1% that the interest rate goes up, it's actually a 12% reduction in price of home that they qualify for. So if they previously qualified for $200,000, rates go up 3%, that's roughly a $40,000 reduction, or instead of $200,000 qualifying, now they qualify for closer to about $160,000. So it is definitely having an impact on the buyers.
So to what extent, as that affordability hits them, are they coming back and saying, well, I'm just going to pull out of the market and I'm just not going to buy, versus I'm going to change my price range? I was really hoping to get into this house. I never dreamed I'd get into something like this. Now I'm going to go back to maybe what was more normal 5-6 years ago.
Yeah, I'm seeing more pull back just because they're saying, well, I can't go find anything in Dodge City for $150,000.
Okay.
I want to look at homes for $200,000 to $250,000, and there's just nothing there. And that goes back to that 17% appreciation. Homes that were listed for $120,000 2 years ago are $180,000 today. So.
Well, actually, so that's the other alternative, right? People have to live somewhere. And if they're not going to buy a home, then they're going to have to rent. So what's been happening with rents in Dodge City area? And you may or may not be able to answer that completely, but what's been happening with rentals in the area in terms of occupancy rates, the rents that people have to pay, and is that a viable alternative? In many markets, I know we've been in a situation where people would say, I don't want to buy because it's gotten too expensive, and then they go and they try and find an apartment, and well, that's too expensive too, and so you're really fighting it on both ends. Michelle, I'm sorry.
Molly?
Molly, say again. What have you seen in that?
Yeah, we've seen the rental rates go up. About all the apartment complexes have raised their rents $50, $100 over the past year, and a lot of that is just supply and demand. They can. Occupancy rates are very low. We have a website that we post housing for rent and for sale, and over the past year, 2 years, it's not used that much. As soon as they have a vacancy, it's filled before anybody even knows about it. So we've definitely seen that.
Waiting lists even, yep. Joe, have you seen anything with that?
Well, I actually am a landlord, so I experience it, but yeah, I have people call all the time and looking for places just because there's nothing available out there. You know, there is some higher end stuff in Dodge City, but a lot of those rents are getting up in that $1,300 to $1,400 a month rent range, and not everybody can afford that. So.
Okay. Nicholas, did you want to share anything at all about the apartment side of the market or the rental side of the market?
I think one of the challenges we have too is we have so much new construction going on, especially with industrial development, that a lot of our rentals are becoming long-term rentals for construction workers. And so that takes away from your traditional workers having rental places, because those construction workers can pay a higher rent temporarily than what your long-term traditional renter would typically be in. And with the wind turbine manufacturing that we've done, and with Hillmar cheese coming online, and just all the construction we've had at the plants locally, basically every rental that's available is being taken up and gobbled up by them folks. And it's getting to the point where our hotels and motels are serving as a long-term, more of a long-term landlord for individuals than what was previously seen.
Very good.
I was trying to find a couple of families, 2 or 3 nights worth of lodging. You know, they came into the church and we were just trying to get them out of the cold. I called 4 different motels that we can afford, and they're booked. And they said, Jeff, we won't have, and we work with them all the time. And they said, Jeff, we won't have an opening. We don't see it for 2 months. A room to rent. Well, and most of it, and they said, they talked about the windmills. That was the thing that they mentioned. And these are your lower priced, motels, and they're just jammed.
Had a couple other comments. I think I saw one here and then one at the back end there. So yeah.
The other thing that you see when you see apartment complexes go up in their rent is your single family home rents are gonna go up, because those are more desired, especially when you have children. The parents want space, they don't wanna be in a complex. As far as what Jeff just said with hotels, we're gonna see that start affecting our tourism side and the guest tax that's able to collect as well.
The guest tax side will be a good thing, but the tourism side is a challenge because if people want to come visit Dodge and they can't get hotels, that becomes a challenge. Another comment or question back here.
Yeah, I just, as a comment, Nick did mention earlier that we're just finishing up a FedEx distribution center building, and it's had several contractors in town. We have some more wind energy projects coming in, and just the maintenance crews for that. And Hillmar hasn't really even started bringing contractors in, and they're estimating, Ryan Companies, their general contractors, estimating 300 to 400 contractors here at all times, and up to 1,200 to 1,500 for several months. And so we haven't even started to see that impact on our hotels and our RV parks and apartment complexes, so.
Jeremy, I think this means you need to bring your RV up to Dodge City and rent it out over the rest of the next couple months. So, well, last thing that I have on my list was about that Mortgage Bankers Association's forecast. And you can say 5%, you can say 5.5%, but if mortgage rates come down substantially from the 7% place where they are right now, what impact do you see that having on your local housing market? So I'll start with you, Joe, and then we'll let you have the last word, Molly.
It may start a new refi boom, I guess, from all the people that are purchasing right now at 7%. But I definitely think there was several people on the fence that weren't able to take advantage or weren't able to find a home within the last couple of years that have kind of backed off with rates running up. I'm hoping it'll take them off the fence and get them back in the market.
Very good. And Molly?
We're building hundreds of units in the next few years, and they'll be sold before they're built, so I don't foresee that slowing down any at all. In fact, this morning we met with an out-of-town developer that's looking to build some housing, so we have those meetings every day with prospects, and so I don't see that slowing down any.
Wonderful. Well, please join me in thanking both Molly and Joe for helping us out today, and I really appreciate learning more about the Dodge City area housing market.